Hi there. Hi there. Welcome to another episode of Lender Chat, your podcast for all things real estate investing. I am Kristen Fleming with KFP Investors, a licensed mortgage brokerage specializing in financing investment real estate in 38 states. I'm going to start, as always, with our disclaimer that we are not attorneys, CPAs, or certified financial professionals. We nor any of our companies give legal, tax, economic, or other investment advice. We disclaim all liability for the action or inaction taken as a result of communications from us or to us, our employees, contractors, clients, prospective clients, sponsors, or participants. You should always consult with your own counsel, accountant, and other advisors as to legal, tax, economic, investment, and other advice. Thank you so much. Today, I am here with Marco Bario, and if you have seen me in a room with Marco Bario, you know that I kind of tremendously fangirl. I think the first time I met Marco, I dropped everything that was in my hands, and I just got so excited. This gentleman is incredibly smart and just really easygoing and great to get along with. So I'm excited here to share with you session 1 of a 3-part series regarding note investing. Marco, will you please tell us more about yourself?
Thanks, Kristen. It's so good to be here. First of all, thanks for inviting me to do this. I'm lucky to have fangirls like you. You're my only one. But,
it's okay, I'm plenty.
Yeah, thanks for the invite. My name is Marco, and I'm a seller finance note buyer. We're going to talk today about what that means, what seller finance notes are. We're going to start from the beginning. I have a background that has nothing to do with real estate. For a long time, I lived in Los Angeles. I left there after 33 years this summer. But I lived in Los Angeles, raised my kids there. They're still there. My son plays football at UCLA. My daughter's in graduate school in California for psychology. And I made a big move east. But what I did in Los Angeles for a long time is I worked in film and television production. All we did is spend money. I never ran a business. I never worried about making income. So there's been a big learning curve for me. This is a whole new phase of my life. And as I transitioned out of entertainment, I went to my first real estate meetup. And for those of us who do those things, every month is a different topic. And one month I was going to buy apartment buildings. The next month, I was going to flip houses. The next month, I was going to, do Airbnb rentals. And then finally, I said to myself, I better pick one or I'm not going to do any of it. And in that month, I went to the meetup and there was a panel of note investors. Some bought non-performing notes. We'll go across that quickly during the presentations. Some originated notes, some were lenders who funded other investors doing flips, but they were all note investors of different sorts, and it connected with me. So I'm really lucky that I was in that room that night. And I would say even luckier that I've been part of a community who I've been able to lean on and ask them questions to, and there's tons of educational content out there if you go find the good people. And it's been a growth path for me. I'm not somebody who's been doing what I've been doing for 30 years. I'm still someone finding my way in some respects.
I think we're all finding our way in some respects, even if we have been doing it for 30 years. But I love that you came to that decision, that realization of I'm receiving all of this information, but I have to pick one path to begin. As you and I discussed off camera before we started recording today, there is often this perception of a sort of career path in investment real estate, that we start with wholesaling property and then we do fix and flips and then we do long-term buy and holds. And part of the goal of this podcast is to show folks that that is not the only way. It's not even necessarily the best way for everyone. I've never done a wholesale on a property, and I have bought one from a wholesaler, and I've never done a fix and flip. So I love that this is where you started and that you're willing to share with us about it.
Yeah. Thanks a lot. Do you want me to go into it now?
I would love that. Thank you.
Okay, so I have slides. I'll do a screen share here. All right, so Kristen, let's do this kind of conversational. I've given presentations. You've been in the room when I have to larger rooms of people, and I like to answer questions and talk as we go. And I love the energy from a crowd of people, but I have your energies today, which is plenty, as we know. So we're going to go with that. I'm lucky. I get to do 3 of these sessions with you. Today, we're going to start with the basics. We're going to crawl before we walk and then run a bit towards the end. And we're going to talk about what note investing is. And to start with, it sounds silly, and I bet some people listening to your podcast won't believe this, but when I started out, I didn't understand. Really, I'd signed a mortgage before because I bought a house, but I didn't really understand what I was signing. I'm not sure that too many people do. And it's taken me a while to really understand it so that I can explain it simply. And this is the simplest way I know to explain it. If you think about it, in most cases, what most people are familiar with is I'm going to buy a house, I'm going to get a mortgage to buy a house. And there's 3 parties involved: the people who are selling the house, the buyers of the house, and there's a lender. Now there's people like mortgage brokers and title officers and realtors, and there's a whole team ultimately is involved in the transactions. But for what we're looking at today, everybody gives something and they get something in the transaction. This is business. This is trading. They're trading one thing for another. And the sellers, they're going to give the deed to the property, kind of like giving the keys to the house. They're going to give up the deed. They're going to give away their ownership to someone else. And for that, they're going to get cash. And the buyers, in a mortgage type transaction, they give a promise. It's weird to think about it, but hey, I promise I'm going to pay you that money, Mr. Lender. We'll talk about the lender in a second. But they get a deed to a property. That's pretty cool.
Yeah.
And the lender, he gives cash. They, companies often give cash. And all they get back for that cash, it might be $500,000 or more, is a promise. They get to keep this promise, this written promise from these buyers that, hey, we promise to pay you back that money. And that's all there is to it.
When you put it that way, it is, it's really almost shocking that for this promise, we will give you $500,000 or more. That's amazing.
But lenders and bankers are smart. They don't just take the promise, right?
That's right. That's right. There's a little more to it.
Right. we want to make sure your promise is worth something. So we'll talk about that part in a moment. This is getting a mortgage. This is what people think about when they go to a bank and they get a loan or Quicken Loans or something like that. I happen to work in and specialize in an area that's a lot more niche. It involves seller financing. So we took the lender out of the process and we just have our 2 parties, the buyers and the sellers. And when the sellers sell, they give a deed and they get a promise. They essentially become the bank. And when the buyers buy, they give a promise and they get a deed. Their role doesn't really change, except who they give the promise to. They don't give it to First National Bank of whatever. They give it to Mr. and Mrs. Seller in this example. And they say, you know what? How about this? We'll just pay you every month. And the sellers say, that sounds great. So investors like me, note investors, all we're really doing is buying promises. If Kristen sold me her house and gave me a promise, I might decide to collect payments for a year or 2 or 3, and then I might decide I'd rather just sell off the rest to somebody else so I can sell her promise to somebody else. So note investors invest in promises, and we buy promises. We step into the shoes of whoever was receiving the payments. And you're going to hear me talk about notes, mortgages, mortgage notes. There's a whole lot of terms for it, and there's a long list of terms. But I want you to understand the basic components that are involved in these promises. There's this thing called a promissory note, and it's really an IOU. If Kristen, if I buy something from you and then I'm a little short on cash, I might say I can pay you next month, And so we made like a verbal IOU, and you're nice and you trust me. And you say, okay. Or we could write that on paper, and that would actually be a promissory note. When we write a check to somebody, that's a promissory note. We make a promise that they can bring that to our bank, and our bank will give them funds from our account to pay them the cash that we promised them. That's a promissory note.
Absolutely.
And actually, you can endorse a check. If I have a check and I want to give the check to Kristen, I can just put pay to the order of on the back and her name and sign it. And then I've endorsed that to her. That's how we buy and sell promissory notes. We just actually say pay to the order of, and they get endorsed, or it's called a launch, fancy name. But anyway.
What a great illustration.
Yeah. So a promissory note is just an IOU. It says how much credit was extended. So the buyers were extended credit for purchasing the house. How much? $500,000, $300,000, whatever it was. Who owes the payments? Who are they owed to? And what are the terms? Well, you're going to pay this much per month with this interest rate for this many months at the basic level. That's all the promissory note is. Generally, unless you get into the big, bank stuff, they're often anywhere 2 or 3 pages. It's not a super complex document. So you throw in all the legal stuff that can stretch them out, certainly. And then the mortgage or the deed of trust is what makes it really valuable. If I buy some outdoor furniture from Kristen, and I say I'm going to pay you $50 a month for the next 10 months, that's great. But I didn't tell her that if I don't make the payment, she can come get the furniture, did I? But if I did make that promise to her, I've secured my promise. In the lending world for real estate, you do that with a mortgage or a deed of trust. They're basically the same thing. We won't drill into the details, and it depends what state you live in. But it's a mortgage or a deed of trust, and that sucker is what makes these valuable. It's not unsecured notes. It's not like buying credit card debt, which people do. These are real estate loans that are secured by real estate. So this mortgage is a second document. It pledges the property. Real property is collateral. It shows there's a responsibility for the payer to pay tax, property taxes, insurance, HOA dues, things like that is a requirement. Why is that? Is because though property taxes become delinquent, that can create a lien on property and they can foreclose. If insurance lapses, the thing burns down, guess what? Whoever's owed their $500,000, they're not getting $500,000 anymore unless there's an insurance company to pay. HOAs can also step in and put in liens if they're unpaid. So that's important. So to protect their investment, there's responsibilities put into these documents.
Before we move forward, Marco, I just want to make sure that it's very clear to our audience the difference between the note and the mortgage or the deed of trust. So a lot of folks think that those are the same document, particularly folks who are not as experienced with lending documents as you and I are. And people talk about, I've got to make my mortgage payment, except that they're not really making a payment on their mortgage. The note is the promise to pay. The mortgage or the deed of trust, depending on which state you're in, those two documents are virtually interchangeable. The note is secured by the mortgage or the deed of trust. So the note says, I promise to pay, and the mortgage or the deed of trust says, if I don't pay, the person who is supposed to get paid can come take the property. Marco is talking about the promise being the note, but the note is secured by that mortgage or deed of trust. So he is acquiring one document that is secured by the second document. Therefore, he gets both of them.
That's really well said. Thank you. The mortgage also includes language that explains what happens if there's a default. Kristen mentioned there could be a foreclosure, which can lead to a sale. By the way, I'd like to mention people who get involved in these types of transactions say, well, it's okay if they don't pay, I'll just take back the house. At the end of a foreclosure process, there's an auction. That doesn't mean that someone gets the house back. It just means that people show up at an auction with their checkbooks and somebody could outbid what's owed on the note, and they get the house. So it's
Mm-hmm.
not a done deal that they get the house back. And what's really great about this type of investing is if I hold a note and it's secured by real estate, this mortgage or deed of trust gets recorded in the county records. So when the
Mm-hmm.
title company does a search, say somebody wants to refinance or they want to sell the thing, they say, ooh, I see Marco has a lien against this property. There's a mortgage recorded in his name for $500,000, and the thing's only worth $600,000. Well, we better check in with Marco then and see how much he's owed if we want to sell or refinance. So I become a flaw in title, which I didn't set out in life to become a flaw in any way, shape, or form, but I love being a flaw in title. I am in the way of things people want to do all the time, to which, Kristen, you've been in rooms with certain educators who say, you get that phone call, or you may get that phone call and say, hey, I see you have this flaw in title, this lien on this property. What would it take to make you go away? And I say, how bad do you want me to go away? So we can negotiate. So it's a very strong position, especially in a situation where the property is worth much more than my lien. It's a great position to be in. If the thing's insured, if the taxes are paid, if the HOA and other liens and things are taken care of that might come in from counties and cities, it's a great position to be in.
I am a cloud on title, and I got one of those phone calls last week that, hey, the owners of the property are selling the property. How much will it take for your cloud on title to disappear? And they can make it rain for $95,000. Go, my cloud goes away. But I'm changed.
Congratulations for being a cloud.
No criticism for flaws.
No, it's a good. So a well-recorded lien with good documents is what makes these so valuable.
Mm-hmm.
Okay. So since I specialize in seller financing, I'm gonna mention other things as we go, but I'm really gonna drill a bit more into seller financing, and I'll tell you in a little bit some of the reasons I love it. But I want to make sure that everybody watching, listening, really understands this fundamental stuff, because the rest is just built upon it, of course. So this is foundation. So if the buyers want to buy a property, more often than not, the sellers are going to say, well, we'll take your promise, but we'll also like to take a little bit of your cash, please.
Mm-hmm.
It gives, why do banks do this? It shows that buyers are serious. It shows that buyers have skin in the game, so they have something to lose at risk from day one, and it creates equity. We have a slide coming up in a moment about debt versus equity, but remember that. Now, equity that the buyers have, and the sellers, from their standpoint, well, it makes their investment safer. Would they want a $250,000 promise against a $250,000 house? It sometimes happens the $250,000 house goes down to 225 or 200, and then the thing's upside down if they need to foreclose. And also, by the way, it takes money to foreclose. So their 200,000, they might spend another, depends where they live, anywhere from $5,000 to $50,000 to foreclose, and many, many, many months or years of headaches. So they would want some cushion. So for that reason, you've heard the term probably loan to value. They want a loan to value. $100,000 down payment would be better for them, but 50 is okay in this situation. Right?
Yes.
So does that explain it pretty well? I mean, the main pieces of this transaction, the buyers give cash and a promise, and the sellers get cash and a promise. That's
Absolutely.
it. Okay.
And to your point about, it costs money to foreclose, and if we think about just the perhaps somewhat more relatable example of someone renting an apartment, right? They're going to put down a security deposit in case they destroy the place, or they have to be evicted, or they leave without paying. It's a similar thought process with the down payment on the mortgage note or the financing, is that Look, if these people vacate their promise, then this gives us some security to take back the property and get someone else to make a promise or chase after the people who made the promise and didn't keep it.
That's right. That's right. If you think about it, that's a good example. If these buyers, Bill and Barbara Bayer, if they bought the place with no down payment, they're essentially renters. It takes so long. We're not going to go into amortization a lot today, but the early payments on an amortized loan pay almost none of the principal down. It's mostly interest. So they're like renters. They're not really buying the property for a while in this situation. So they don't have a lot to lose. So if they decide on January 1st, you know what, we'd rather be living in another place, or one of us lost our job, or they could just as easily pack up their stuff and go. They don't even have a security deposit to worry about. Okay, I think we've hammered that home. So we talked a couple of weeks ago, Kristen, about the difference between debt and equity. And I understand that it's confusing. Newer investors will be in rooms, they'll read investment opportunities, and they'll hear the word debt and equity. And Kristen, to your point, it's probably not well enough understood. So we've set the stage here to, I think, explain it pretty quickly with our note and our cash down payment.
Great.
We have our $250,000 house. The sellers are going to receive this promise, which is debt. The buyers, they put up $50,000 cash. They really, at the end of the day, only own $50,000 of the house. They have the title to it. It's theirs. If someone says, who owns this house? They're going to say, well, these buyers over here, they own that house. If a foreclosure happens, the sellers are going to go through a process that gets them their $200,000, and the buyers, if they're lucky, are going to get some of their equity back.
Yeah, it's really a fun scenario when you think about it. I think from the buyer's perspective, that you get to own the deed of the property, which is 100% of the property, with only having to put up $50,000 of a $250,000 purchase. So I'm a big fan of leverage, but I'm also a lender. So
yeah. Now, what happens if the $250,000 house appreciates to $300,000? Who gets that appreciation, Kristen?
the buyer does, because they
Bingo.
own the deed of the property.
Yep. That's right. That's right.
So it does not change the seller's terms at all.
Doesn't change the terms at all. It doesn't mean that. I get this a lot. People call me and they want to sell a note. They say, I should just let them default because, man, the house is worth $300,000 now, and I would just get that sucker back. But remember what I said in the beginning, you don't always get the house back. And if a bunch of investors who love to go to foreclosure auctions say, oh, this house has a lot of equity in it, I'm going to put an offer in on it, and I'm going to get that equity. These sellers probably aren't going to get that house back.
Right. So if you foreclose on a property, Marco, and let's use this scenario of the $200,000 note on the $250,000 purchase. Bill and Barbara Bayer, they bought the house with $50,000 down. You are the lender, and you've got this $200,000 note. The property has appreciated to $300,000. So you foreclose on the house and you take it to auction, and you sell it at auction for $275,000. What do you get?
I get $200,000 plus, and it's state dependent, certain reimbursements for costs incurred, legal costs and things like that.
And what happens to the rest of the money?
It's owed to the buyers, or or if there was another creditor out there. But what's left over is owed to the buyers as their equity. We're going to drill into the note. Real estate. I tell people, say, what do you do? I say, I'm a real estate investor. They assume immediately I buy property, houses, whatever, trailer parks. But I really buy debt. And then if I want to see them glaze over, I say, well, I really buy notes secured by real estate, or about like mortgage notes. They've heard the term mortgage before. Secured by, they're like, and then they change the subject because like fast. So, I mean, have you ever turned on HGTV and seen Flip This Note ever? It's not very exciting, right? I don't get to remodel the kitchen with notes. I
It's
don't
less
get to.
desirable to choose a paint color for a note.
I mean, I would watch it, but Kristen and I and like 5 other people would watch it. But we're gonna drill into the boring part. And I don't know how much people viewing this follow investing, but often the most boring things can be the most profitable. When I was starting out, there's one of the teachers out there loves to point out that if you think about the tallest city, the tallest building in most cities, it usually has the name of a bank on top.
Or an insurance company.
Right, which is kind of like a bank, by the way. So there's something here. So we better drill into it. By the way, when we were talking in the beginning and starting out, one of the things that drew me to note investing is I realized I'm kind of like in high school, I took auto mechanics. I never became an auto mechanic. I just love to know how things work. And I thought not having a real estate background, if I got into the finance side of it, it would drag me through the world of title and finance and all the paperwork and all that nonsense. But I thought that's how I'm going to figure out how this thing works. The magic's in the financing, really, and the paperwork and the paper. But anyway, so we have this note and mortgage. We'll just call it mortgage note or note. And the big numbers are, this particular one was $200,000 starting balance. I just gave it an interest rate I made up of 7%. That would make the payment 15.60 cents every month if it's paid over 240 months. Kristen, what happens if I change that term to 360 months? What would the payment be, higher or lower?
The payment would probably be a little bit lower, but hopefully as a financier, the interest rate would be a little bit higher because that's greater risk for you. So you need to be compensated for that. But for the purposes of this discussion, if you change it from 20 years to 30 years, the payment would go down.
Payment would go down, that's right. So we're assuming that these buyers can afford a payment of $1,550 a month, or this wouldn't have probably been a 240 month, or it would have been unwise to create a term of 240. We've got a 7% coupon rate, as they say, interest rate. We've got payments of $1,550 a month, principal and interest. This is a fully amortizing loan. My phone is ringing and it does it through my computer. Can you hear me okay, Kris?
I can hear you just fine, and I do not hear the phone.
Okay, good. I wasn't sure how that worked. Yeah, so this is the note. And I'm an investor, and someday somebody might call me. Maybe a few payments have been made and the balance has gone down a little bit, but they might want to sell this note. I like interest rates a little bit higher than 7% for me. I do a lot of work. I spend money marketing. 7% is good, I think, for a passive investor. I like to go a little bit higher for the risk I'm taking and to be reimbursed for cost and things. So there's this magical tool that I encourage everybody to go buy and learn how to use called the 10BII Financial Calculator. This is a screenshot from the macOS version that I use every day, but I also have it on my phone, iPhone, Android. It's like $5 or 10 or 15 for your computer.
Yeah, it's not a monthly cost. It's like $10 period, and then it's amazing.
Kris, I was at a holiday dinner in Los Angeles a few years ago, and I was sitting at a table. And as I do when I'm out all the time, I start talking about notes because that's, of course, what people want to talk about. And I pull out my financial calculator and I say, do you have this thing? You got to get this thing. It's great. You go here and you download it and it's $5. And there were 2 couples sitting at the table with us who were part of the conversation. And I look over and one of the women is smiling. Like, what? She said, these 2 guys here, they wrote that. What? They were in a day development who wrote it. I was like such a fanboy at that moment.
Wow.
I use this thing every day. I was sitting at the table with in a day development right there, the 2 guys.
No kidding. Wow.
Yes.
Autographs, Marco.
Yeah, you need to get them on your show. You need to get them on
Yeah,
your show.
that would be amazing. I love it.
So with the financial calculator, you could do things like figure out what's the monthly payment. What's the monthly payment if I change the term to 360 months?
Mhm.
What's the monthly payment if the interest rate is 10% instead of 7%? And that's what I did here. I thought, well, maybe I haven't shared all the factors here yet, and I don't know them
Mhm.
because this is made up, but maybe this is a note I'd be happy to buy at a 10% yield. So I can essentially create a yield for myself
Mhm.
by changing the interest rate in the calculator and solving for PV, present value,
Mhm.
which in this case, present value on the left is what the current balance is. The present value on the right is my imaginary. Here's really what I want to pay for the thing balance. And then it would be up to me to negotiate with the seller and say, I can pay this for your note. And they can
So
choose to accept that or not. Go ahead.
I have to play devil's advocate here, Marco. I'm the buyer, and you can't just go changing my interest rate from 7% to 10%.
Glad you brought that up. I'm buying, remember the check that I'm going to endorse to Kris and say it's a $50 check.
Uh-huh.
And I say, pay to the order of you. And you take it to the bank and say, yeah, he told me this check was now worth $75. No, it's a $50 check. They're not going to do that.
Right.
So the terms on the note are the terms on the note. All I do as a buyer of a note is step into the shoes of the previous note holder. So what I'm really buying is the right to receive 240 payments of $1,550 a month. That's all I'm buying. But because I buy it at a discount, my effective yield, the magic of the calculator and the magic of how these things work, my effective yield is 10%.
So if I could expand on that a bit using the check example, if my grandma writes a check to me for $50 for my birthday, and I don't have the time to go to the bank, I don't have the inclination to go to the bank, I don't, whatever, I just don't want to deal with this check.
Uh-huh.
I could say to you, Marco, I will sign this check, this $50 check over to you, and the check is still worth $50. And you just give me $40 for it. So you buy the promise from me for the $50 check, and I will accept $40 in exchange so that I don't go to the bank anymore.
Don't people do that with prepaid phone cards? I
I
saw
don't
that
know.
on
Do you?
I saw that on The Sopranos. Anyway, your grandmother wrote the check, and I'm sure it's going to cash. So I would do that deal with you in a heartbeat.
So that's part of what I want folks to understand too is the person who loaned the $200,000, they have a promise, as Marco said, they have a promise of 240 payments of $1,550.60. And Marco is buying that promise of those payments. And so the people who received the promise no longer have to wait 240 months to get their money. They get their money now, and Marco gets the promise. Just like in the check scenario, I got my $40 now, and Marco gets the check from Grandma.
Yeah. You know what else happened? I'm gonna forward a slide now so we don't have to see the financial calculator and go back to our nice people. What else happened for these investors? They got a $200,000 note, $60,000. Did the value of the house change?
No.
No. Are they in a safer position?
Yes.
Yeah. They didn't invest 200, they invested 160. If it goes south and they have to foreclose, there's more cushion for them. The house could
That's
drop
right.
to $180,000 in value. They'd probably still be able to get their money out.
Did anything change for the buyers? Bill and Barbara Buyer, did anything change for them?
Yes, they'll get a nice letter in the mail saying, please send your money here instead of there.
Right.
That's all that changes.
Love it. Love it.
You know, I buy the seller finance notes, and they're mom and pop originated and generally, you know, not professional payers. Bob sells to Susan kind of thing. And most of
Right.
the people who I buy from, they've only ever created one note in their whole life and therefore never sold one until they came to me. And the people who are making the payments, they've probably never done one of these before, and they're terrified that, oh my God, something's going to change. So I
Right.
call them in my nicest, calmest voice, and I explain to them, like I explained on this call, I legally can't change it, but I wouldn't. I want your 240 monthly payments. Please make them on time. I'll tell you where to make them. Beyond that, we're good. We're good.
Perfect.
So one other question. The investors here, they paid $160,000 to get $200,000 in balance. There are kind of two promises here. It's an either or situation. The payer said, I'll make you 240 payments of $1,500 or whatever a month, or I could always just pay off whatever the balance is. So what if after a few months goes by and the balance is still $189,000? It hasn't changed much, and something happens and they decide they want to pay it off. How much do the investors get? 160 or 198?
The balance of the note, the
The
198.
balance of the note. They do pretty well. They could make a big return. So discounting isn't just for interest rate. Sometimes I discount because I want more equity protection. I want to be lower than the value of the property by wider range. And sometimes I just have a feeling that most notes really do pay off in 7 or 8 years. They don't usually go to term on average. So I like those early payoffs. It can really increase the yield.
That's terrific.
Yeah, does that make sense?
Yes, I often speak to the fact in my business, I often speak to the fact that the average note is held for approximately 7 years.
Yeah, no, that's true. I get that data from a couple places, but there's one really large buyer of seller finance notes in the industry. It's a bank in Michigan, and they've been buying them 50 years. They have tons of data, and
Yeah.
they assume they pay off in something like that.
I think I've met those folks.
I think you have.
Yeah.
All
I
right.
think they're fans of yours too.
Yeah. No, I have a good relationship with them. So I like these nice little seller carrybacks, seller finance notes. I love dealing with people from all over the country. I bought notes. I own a note secured by a property in North Pole, Alaska.
No kidding.
I own a note secured by an island that's in the middle of a lake in Washington State. It's amazing the weird stuff that's out there, but what's really neat is the people I get to talk to from all over the place. I sit in my chair currently in Maryland and run my business. I don't go to the properties. I have people look at properties and give me a price opinion, and we check title and we look under the hood. But when you call Quicken Loans and say, I'm going to buy the house down the street and I need a loan, please, Mr. Quicken doesn't drive there and look at the thing, and no one on his payroll does either. I made that up. There's no Mr. Quicken. But they send, they send an appraiser and they look at title, and yeah. So I can do what I do from anywhere, and I get to talk to the nicest people from all over the country. It's so cool. It's so cool. So what I focus on, my niche, is seller financed and performing. When I started buying notes, remember I went to that meetup when I was starting out. There were a couple of people out there buying non-performing junior liens, and there were tons of them out there coming out of the financial crisis in 2008 time period. And it was interesting, and I learned a lot working in that space. But I got started working just with lawyers and loan servicers all the time. I want to talk to people.
I have 7 of those non-performing junior liens on my desk. Just I don't know, almost 2 years ago.
It was a weird day yesterday. I got 2 phone calls from people who had $180,000 seconds that they wanted to sell. I said, "Did you just call me?" When the second guy called, he said, "No." I said, "That's weird because 45 minutes ago someone called and had $180,000 second." I don't know. Yeah, I don't know what's going on with those. I don't buy junior liens anymore. The reason I own a few. We won't go down this rabbit hole, but right now I focus on notes that I can resell, and it's easier to resell something that's in first lien position. The more buyers, so I focus on those. But just be aware, there are loans originated by institutions, and they get sold off. Generally, they get sold off performing to big funds, and none of us probably on this call are part of that, as a collateralized debt, it's big securitized pools. But when they go non-performing, they get sold off in smaller pools, and those get broken up, and those get broken up, and some of those loans are available as non-performing. And sometimes you'll see those in the marketplace. They've now been worked out and they're re-performing. Occasionally, I guess you could see a performing one. Usually you don't. Or private people. I could loan an investor, $500,000 to do a flip, or if it's going to be a buy and hold, and I've got a retirement account that has some cash in it, and I want to lend it to someone, and they're going to make payments to me for 15 or 20 years or whatever we agree upon. That's called a private note. So lots of places to focus. I focus on what I like to do every day.
I love this diagram. And just for funsies, I will point out to our listeners that there are people who flip notes, just like there are people who rehab and flip houses. There are people who rehab and flip notes.
Yeah. I do that to some extent. So why seller financing? I mean, is there a marketplace? Some people, I still run into people sometimes and I explain it to them. They say, that's not legal. You can't do that. Sellers can't. Yeah, it happens all the time. So just in 2023, this is data compiled by Advanced Seller Data Services, who looks through county records across the country and sells off those records to people like me who market to owners of seller carrybacks. They filter out the others and they make those leads available. And then noteinvestor.com, who's a couple of my mentors, Fred and Tracy, and they compile the data and they create a report from it. So this is their information that they share to the industry, which is great. And just in 2023, there were almost 90,000 seller finance transactions for combined balances of $28 billion. And it was a bit of an uptick year. I mean, interest rates were higher and it was harder for some people to qualify. And there's, some reasons you can extract as to why it might have upticked a year. But on average, it wasn't too far above mean. So over the last 5 years, you can see $125 billion. A lot of those are still available for investors like me to purchase. Eventually, people want to sell them.
Wow.
And what's interesting, I told you, I target the mom and pops. It's just my wheelhouse. I enjoy the process working with them. And 86% just in 2023 were created by someone who, or people or family or trust who just made one the whole year. So we're not talking, this isn't big investment stuff. This is just mom and pops, mostly Main Street stuff. And I am always surprised by this statistic. It's tracked for the last few years. The average down payment, 26%. I don't see a lot of those. Maybe there's something that's polluting this data, but 26% is pretty high, I'll be honest, for seller finance. It's not uncommon to see 5 or 0. I hope for 10 or more. Some people just like to do business with people and not banks, like me, by the way. But also land is hard to get third-party financing for. Mobile homes or mobile home and land is hard to get third-party financing for. Small transactions, because it costs the banks a lot of money to underwrite these things. They've got stabs and compliance things they have to deal with, so they don't usually go under a certain dollar amount. Properties that are in not insurable condition or questionable condition, but really the bulk of them, I'll say, kind of the term in our world is penalty box buyers. There are a lot of buyers out there who own their own business, and it's hard for them to qualify under the bank's guidelines, or their credit isn't quite perfect. And sometimes that's just because they had a divorce or a health issue and they had a bump. There are ways to underwrite them and still determine. I mean, if they've been a renter for 10 years at the same residence and the landlord says they were great, didn't miss a rent payment, okay, great. I don't think that banks underwrite at that level. There's a lot of other cues you can look for and figure out if they're a good credit risk. And by the way, when I buy these notes, I look at some of those too. So I'm not just rolling the dice on these by any means. Anyway, so it's a neat world and it's big enough. There's only a few of us who operate in this space, and it's big enough. So when these notes are bought and sold, it's called a secondary market. Most of the buyers who are out marketing are professional buyers like myself. But you're a professional if you say you're a business and act like one. I focus on reliability. I want notes that I have a high probability of being repaid.
Yes.
So right? So I look at the payer, and I look at the credit history, and I look at the payment history, and all these different cues that I can gauge, is this thing going to continue being paid? And overall, it's a marketplace. So just like every other marketplace, pricing is affected by things like interest rates, real estate markets. If the housing markets are going up, that's good, because then my note might have more equity protection. But if it's going down, then I might press the pause button.
Okay.
Capital markets, risk appetite, all these things. When you turn on the business news, you hear about risk appetite, of course, laws and regulations. And I'll mention that most of the notes that I buy are for owner-occupied property, so it's consumer debt. It's highly regulated, and I'm very careful about that. So, and of course, you want to treat people right. So, the way we price notes, ultimately, there's like 3 P's that people talk about. One of my mentors is Bill Tan. You know Bill, Kris? Yeah.
I have not had the privilege of meeting Bill, but I have read some of Bill's material.
He's great. And he points out that the ultimate payer of a note is the property. Because if all else goes to heck, it's the property that's there to make the investor whole. So that's really important. I make sure the property is solid and title is good and the value is there.
No clouds, no flaws.
No clouds, no flaws. Right. I make sure that the person making the payments is likely to continue making the payments. And then we get into what are the terms of the thing. You saw an example. I buy notes, believe it or not, that are written at 0% interest. I tell people, call me, you're not going to like the discount. And here's why, because you're at 0%. And I don't work for 0%. So they're like, oh, okay, I understand. But they're out there in seller financing. But you saw that through the financial calculator, I can adjust the interest rate. So if I don't like the interest rate, I'm going to make an offer that gives me a rate that I like, a return that I like. So the terms, and ultimately, am I able to enforce the lien? Just because there is a mortgage doesn't mean it's enforceable and that things were done properly. And we get back to title and clouds and things like that too. And in my world, by the way, Kris, and this will certainly something you know a lot about, is I always buy lender's title insurance when I close. I close your title and I buy lender's title insurance policy. So I know that either title is clear, and if it's not, I have an insurance policy that says, this, you guys missed this, and now you owe me because I can't collect on it anymore.
And as a lender who often creates notes, I just, from my own personal peace of mind, I won't do a deal unless the buyer also gets owner's title insurance. That has nothing to do with my loan. That just has everything to do with protecting the buyer.
Good. It's really inexpensive in the scheme of things.
Yes.
And if there's an owner's policy being purchased, the lender's policy is pretty inexpensive. It's kind of almost like an add-on. So it's a good time to do it. And they're generally assignable. There's sometimes I can get the lender's policy assigned to me, but the fact is, in seller financing, usually there is no lender policy. So we have to start from scratch anyway.
I did not realize that they're sometimes assignable.
Yeah, and or assigns.
Okay.
The title companies will push back because the search was done a long time ago. So they're going to want they're going to say, well, it's $500 for a new search. Kind of, fine. We need to. They call it a date down, I think, when they update it. But sometimes there's some back and forth there. Sure. If there's a policy. So there's a lot more we're going to cover over the next 2 sessions. But today, I hope that I laid the foundation that these are valuable assets that are good investments, and understand how they're bought and not how they're bought and sold, but high level how they're valued and priced. Yeah. But so I hope I set the foundation. I tripped on my words there. I hope I set the foundation. But there are a lot of ways to make money. There are a lot of strategies. Kristen actually mentioned flipping notes. I do that to some degree also. Often I'll put notes under contract, just like a house wholesaler puts a house under contract, and then I just assign the contract to a buyer and I make a fee. So I wholesale notes.
Interesting.
I buy
Never occurred to me that you could do that.
I buy and hold notes just like people buy property and hold it for rental income. I buy it and hold it for note payment income. I flip notes, generally buy non-performing anymore, but I do buy ones that are seller originated and aren't quite perfect. So I buy it and I get it boarded with my servicer and I get a nice clean payment history going for 6 or 12 months and I get a title policy on it and make it look like a professional loan. And then either I'll sell all or part of it sometimes. Sometimes I just sell a piece of a note called a partial.
I'm looking forward to discussing partials.
Good.
I think that's another just very little known facet of this industry.
It's a good place for people to start out as buyers too, because it's a small bite at the apple. NPLs are non-performing loans, so some people buy those and work them out to get them performing again. Some people, there are strategies where people foreclose and expect to take the property. Usually it's a vacant property or something that's gone through an estate or a probate type situation. No one really wants it anymore. Partials, we'll talk about that. Hypothecation is a kind of a take on partial where the loan is used as collateral for another loan. And then a lot of note investors, they start by buying property and they sell the property to create the notes themselves.
Yes. There are quite a few investors with whom we work that is their total strategy is to purchase single family homes that are good starter homes for penalty box buyers. And that's their whole real estate investment strategy is seller financing to those folks. I love it. Thank you so much.
You're welcome. This is me. I'm not going anywhere. We're doing this a couple more times. This is my company, and I would love to, anybody listening, I'd love to invite you to subscribe to my newsletter, just my company name, newsletter.porchswingfunding.com. And that comes out every month right now. It was weekly, but I got a little busy. But I share tidbits and things about note investing. I don't sell anything through that.
I can vouch for that it's a valuable resource and that I have never felt pitched to as a recipient of the newsletter. So thank you so much, Marco. I am really looking forward to our next 2 sessions. I am learning a lot from you, and I just really appreciate the time and your willingness to spend it with me and our listeners. Well, this has been Marco Bario with Porch Swing Funding. I encourage you to reach out to him. He is just an incredible resource. I love talking about quotes from famous people. I am not famous people, but this is a quote from me. I propose that consumer debts are the handcuffs of poverty, and the paid off home mortgage and 10K are the handcuffs of the middle class. So let's talk about how to build your net worth legacy. If you would like to reach out to KFP Investors, this is where you can find us, kfpinvestorsllc.com. Contact at kfpinvestorsllc.com is our email. And here is our QR code to request more information and subscribe to our newsletter. Thank you again, Marco.
Thanks, Kristen. Thanks, everybody.